I love this quote. The stock market is a giant distraction from the business of investing. So the man who said that is John Bogle, and he was the founder and chief executive officer of the Vanguard Group and was credited with popularizing the indexed fund. So that's the individual you see pictured here. Now, I worked at MSCI for over a decade, and we built the indices that power ETFs. That's how MSCI went from a $2 billion company to the $44 billion company it is today. And we often sold indices or licensed them to companies like Vanguard. And what was known throughout the industry is that Vanguard competed on cost. And we also know that cost is the most accurate predictor of fund performance. So Mr. Bogle figured that out because he was an avid investor and money manager himself. And of course, he preached that you should be an investor, not a speculator, and that reducing broker fees as much as possible was going to help you outperform. Now, back in Mr. Bogle's day, that would have been where you were charged $7 a trade by companies like Ameritrade and whatnot. But these days, most brokerage firms, thanks to Robinhood, have dropped their fees. So when he talks about reducing fees, you need to think in terms of expense ratios. So he said that the ideal investment vehicle was a low-cost index fund representing the entire U.S. market. Now, I think that people who follow his methodology now understand that the world is a lot bigger than the United States. So that's where the three-fund portfolio comes into play. We're going to talk about that. And I love this saying. He says, don't look for the needle, just buy the haystack. Of course, he's talking about people that are trying to find the next Microsoft. So if you're somebody that has an investment advisor and they don't sound like Mr. Bogle, then they probably don't have your best interests in mind. In other words, the wisdom that he's dispensing is pretty much ground truth for anybody who's an experienced investor. Now, those who are not experienced often gravitate towards what we call sacred cows. So these could also be referred to as stock cults. And I pulled some characteristics of cults from a website and listed them here and can give an example. So a cult has a charismatic leader. Do you think of Karp or Noto or Musk? Ideological purity. So critics of these companies or stocks are often attacked by the cult's followers. We see this all the time. There's this us versus them mentality. So any company that competes with the sacred cow is condemned regularly by the cult members. So you can think of Palantir and Snowflake. So if you dare invest in anything except the sacred cow, then that's a sacrilege. And there's this notion of apocalyptic thinking. We're all going to the moon, right? And diamond hands all the way. You'll see the talking heads who drive these stock cults spend nearly all their time parroting press releases and going into analysis paralysis. Now, if you're invested in one of these stocks, stay away from the community and their cult-like behavior because sacred cows do not make better investors. Now, there are also cultural cults and this notion of a cult following. So, for example, you have parrot heads. They would be fans of the great American philosopher Jimmy Buffett. You see him pictured here, unfortunately died rather recently. Deadheads, they were followers of the Grateful Dead. If you imbibe too much as a deadhead, you'll turn into a basehead. Those are people who really, really, really like smoking crack. And then there are Bogleheads, people who follow the investing philosophies of John Bogle. And it's rather interesting. They have this Craigslist-looking website that's full of rich value and a very connected and helpful community. More than 120,000 registered members across the globe. The site receives an average of nearly 2,000 posts per day, so very active. Members participate in national or local chapter get-togethers, so it's quite interesting. You would maybe describe them as a cult in some characteristics, but the real difference is they're actually helping people become better investors. How? Well, what they do is follow a few simple investment principles that have historically produced risk-adjusted returns that are better than the returns of average investors. And that's proven academically. And their principles are as the result of Nobel Prize winning research, things that are a little bit too boring to get into, but they're easy to understand and implement. And using these principles, such as the three-fund portfolio, it makes it very simple for anyone to invest successfully with a small amount of effort. So I wanted to stop for a second before we get into the three-fund portfolio and welcome all Bogleheads who might have clicked on this video and want to see what we're all about. So you're in the fortunate position to have already figured things out if you're a regular over there in the Bogleheads forum. But please do subscribe. The link is in the comments to our newsletter, and do join us, and we'll talk a little bit later about what we do. So the three-fund portfolio concept, this was brought up to us numerous times by paying subscribers, and it's certainly worth covering. The gentleman here who describes this idea, Taylor Larimore, is a living legend. So he was a World War II paratrooper in the 101st Airborne Division and now spends his time sailing, not unlike Mr. Buffett, in helping others discover the Boglehead way on the Boglehead forums. So the advantage of the three-fund index portfolio, I wanted to go through these very quickly. So he talks about diversification, over 10,000 worldwide securities, okay? Contains every style and cap size. Maybe. This is where you need to dig into the underlying indices of the ETFs to understand that. So these different index providers classify size using different methods. So this is why, when we'll talk about it in a second, you want to stick with index families and understand what you've actually invested in. Of course, low cost, tax efficient, no overlap. That's going back to that comment. Talks about never underperforming the market. That's because it is the market, right? And mathematically certain to outperform most investors. That's because most investors can't outperform the market. So it's very simple and it makes a lot of sense. And when you look at this slide here, keeping it in the family, you're going to want to pick your three-fund portfolio using a particular provider for the reasons that I mentioned so you don't have that overlap. And then you want to pay attention to when these providers sometimes change the underlying indices of their ETF. Now, you don't need to worry that much. The fact that you're putting together a three-fund portfolio, investing in it, and balancing it, of course, will say, what should my percentage allocations be? That's a common question that we receive relating to this strategy. We'll talk about that. But just make sure that the international is ex-USA. So I looked at the BlackRock ETFs here, and that MSCI Total International Stock ETF, that is ex-USA. I think it's 7 bips fee, so it's quite good. And you could see here 3-fund versus 4-fund. So some people say, well, maybe you ought to not just have U.S. bond market exposure. That's a fair point. So maybe you go international bonds. But I wanted to touch quickly on the principles of Bogleheads. And I took this directly from their site. And anybody who's a regular reader here at Nanalyze hears us say this stuff all the time. Live below your means. Develop a workable plan. And that seems to be where most investors don't start. They jump right into the distraction that's the stock market, and they don't come up with a plan before that. Never bear too much or too little risk. We're on the never bear too much side, so we're risk-averse of investors. That's my background, is in risk management. So we certainly take that approach that I think the more wealth that you accumulate, the older you get, the more risk management becomes something that's an emphasis versus growing your wealth. So when you have wealth, you want to protect it. Invest early and often. That's critically important. Diversify. We say that over and over. Invest with simplicity. I think everything we produce here at Nanalyze is simple. Our simple valuation ratio, for example. Minimize costs. We know that expense ratios are the single most accurate predictor of performance. Never try to time the markets. We always say it's about time in the market, not timing the market. Stay the course. And the things that we don't really get into that Bogleheads do is using index funds when possible. So we deviate from that a bit, and I'll talk about why. And then minimizing taxes. We don't really get into taxes much because they can be very complex. Half of our readers are from overseas. And then we need to start getting into international tax law, and that becomes rather tricky. Now, what we do here at Nanalyze, we help people become better investors. To do that, we run 2 strategies. One's risky, that's disruptive growth stocks, and one is safer, that's dividend growth stocks. And we do a great job of attracting newbie investors with that tech stock strategy, or those investors who have made lots of mistakes like we have, because the appeal of exciting stories, which is generally what tech is what leads us to make the most and worst mistakes. So those people trying to chase the sort of get-rich-quick ideas that you see common in tech stocks and new and exciting technologies, that often doesn't pan out very well. So we're some of the few tech investors out there that take a risk-averse approach to tech investing. Now, how most people begin investing is that they'll see something exciting on the news and they'll want to invest in it. So I think it was one of the Kennedys that said, when even shoeshine boys are giving you stock tips, it's time to sell. And people don't decide to start investing in bear markets. They do it in bull markets, and they invest a lot at peak hype. So, and they make the mistake of trying to trade too much. So as Bogle said, the more you trade, the less you earn. Now, the most exciting themes then are the ones that attract the most newbies, and that's one of the reasons that we cover cannabis. So if you're able to invest, then you've taken that first step. You decided you want to be an investor. That's great. Course correcting as quick as possible is going to help determine how much wealth you amass, because remember we talked about the earlier you start, the better. Well, the earlier you correct your basic mistakes, the better off you're going to be, because time is the most important contributor to wealth creation. The Bogleheads, in their description of how they invest, have a chart that shows that, a great chart, one that we've used in a different manifestation of that same idea, and always start at the asset class allocation level. So for Bogleheads, this map here, they call it the quilt, I've seen thrown around, and it's a great example of the importance of diversification. And all this is showing you is the relative performance of various, you could call these asset classes, although they're mainly, if you're talking asset classes, it's usually property and stocks and bonds and commodities. So they're showing those here, but they're also throwing in things like small cap, mid cap, large cap. You could call those asset classes too, I suppose. But the idea being here that when you have a diversified portfolio across asset types or asset classes, that they're going to offset each other so that you sleep a lot better at night. When we look at our own asset class allocation, you can see here Quantigence, that's our dividend growth strategy. So whilst a Boglehead might have fixed income in that component, we don't like fixed income. Why? Because at 3% inflation in 20 years, your income's halved. And we don't want our quality of life to go down as time goes on. So we believe in what Buffett calls equity bonds, right? Dividend growth stocks that increase their income, that increase your income every single year predictably, the notion of dividend champions. Nanalyze would be our risky tech stocks. We like tech and we don't mind taking some risk. And as I said, it's part of our business that attracts newbie investors. And then, of course, Europe and Asia, their international exposure. And we also throw alternatives into our strategy. So these are fun things, wine and art and gold. So maybe those are things that if you don't enjoy those sorts of fun asset classes, and perhaps you just leave that out. But they provide some great diversification effects. Now, experience versus academics. Advanced education it's really something you desperately try to navigate while job hunting, at least when you're an MBA. Now, my second attempt at master's level finance classes, when I actually did a proper master's in finance, some of those principles started to stick, but in no class did the teachers teach us how to accumulate wealth. And what happens is that experience as an investor and in operating an industry as well leads investors to certain ground truths, such as what John Bogle has preached and what the Bogleheads preach. These are things that you can't disagree with. Now, people who have money and consistently grow that money over time understand how wealth is made and preserved. And it's not in what all the talking head instant analysts out there are trying to promote and that are pretty much commanding the new generation of investors. Now, the Boglehead philosophy characterizes our own philosophies, and this is where I think we deviate. Some people want to be more hands-on, and that's where our dividend growth strategy comes in. And I think that also repackaging these age-old principles for whatever generation you want to, whatever younger generation you want to describe, while making it interesting is certainly appealing. So just some parting thoughts, a couple comments from Mr. Bogle here. Investing is not nearly as difficult as it looks, and he is absolutely right. Successful investing involves doing a few things right and avoiding serious mistakes. We call these pitfalls or landmines, and those are the pre-revenue companies or the companies with negative gross margins that end up blowing up. So we have people that ask a lot of questions, premium subscribers, because they're worried about making serious mistakes. And I think most of them are already past that. So are you diversified based on your total assets under management so that you're not betting the farm on a single stock? Are you investing in shite stocks? So no revenues, negative gross margins, some instant analyst recommendation. Are you dollar cost averaging? In other words, are you trying to time the market? And that's not a good thing. And most importantly, as the Bogleheads say, do you have rules and an asset class allocation strategy? So future topics relating to this, should we analyze the recommended 3-fund portfolio from Vanguard or Schwab? We might. And that percentage allocation question comes up a lot. So what you can do there is if you're dollar cost averaging, you can adjust the amounts to allow for movement and try to stick to whatever weightings you've decided upon, but don't sweat it too much. I mean, and you should set objective rules. So the 100 minus your age rule, for example, that financial advisors use is one such method that you can use to put some objectivity into that. And for our own 3-fund portfolio, or say multi-fund portfolio, we substitute bonds for equity bonds because we prefer growing income to fixed income. So if you're a Boglehead, please let us know in the comments what you love most about your community. And after you've done that, make sure to check out our next video here on dividend growth investing. This really describes our own proprietary strategy, Quantigence. So please make sure to subscribe to this channel. Thanks so much for taking the time to watch this today.